did you write another book? What's the purpose of this?
Well, so the book is largely, though not entirely, a collection of previous writings. It's pulling stuff together. It's an election year. Lots of stuff is in discussion. And also
a lot of bad ideas that need to be knocked down.
The zombies are running wild out there right now, and so I thought it was a good time to get that stuff out. A zombie idea is an idea that should have been killed by evidence. It's clearly false, but it doesn't. It just keeps shambling along, eating people's brains, and things like tax cuts pay for themselves. That's the ultimate zombie in U.S. politics, and God knows we're a very zombified political environment right now.
Well, let's start with one of those concepts, and this is more of a global one, and that's austerity. I mean, you talk about this in several sections in your book, and this idea that we moved, meaning the world, to sort of these austerity measures, and that was largely on the back of sort of a misguided or misinterpretation of the role debt plays?
Yeah, there was tremendous excess concern about debt. Somehow or other, in 2010, with still mass unemployment, with tens of millions of people unemployed across the advanced world, somehow everybody turned to saying debt is the problem and we need to do austerity policies, which really did a big deal in delaying the recovery. And and what's amazing, of course, now is we did a 180, and suddenly now we're having Deficit-Palooza under Trump at a time when unemployment is much lower.
But the weird thing is, so we have unemployment at 3.5%. We have Deficit-Palooza, as you call it. What we don't have is inflation. And I think a lot of people would have guessed that if you're running $1 trillion deficit at 3.5% unemployment, we would have seen some sort of upward price pressure. And I'm curious, politics aside, to what degree should either the Federal Reserve or the economics profession rethink some of its assumptions about the relationships between spending, between unemployment and inflation?
Well, on the spending side, actually, before the crisis, if you asked sensible Keynesian economists what they thought the multiplier on government spending would be in an flat interest rate environment, they would have said 1.5. And after the financial crisis, it looks like it's 1.5. Actually, basic macro on the demand side has actually worked very well. So the clean little secret is that your basic understanding of how spending affects growth, how fiscal policy works. Now, what has been a surprise is that the labor market. If you had asked me, well, wouldn't we be seeing inflation at 3.5% unemployment, even I would have said yes. I wouldn't. It is remarkable. Now, some people say that means there is no relationship. That can't be right? If 95% of prime working age adults were employed, surely we'd be seeing a lot of upward wage pressure. But it turns out that we had a much less good idea of where that point is, of how full is full employment. Clearly, it's a lot fuller than we thought was possible, and the Fed has been consistently wrong. The Fed has consistently thought that we had no slack, and it turned out we did.
Okay. Well, I was speaking to Atlanta Fed President Bostick saying that they're actually doing a pretty good job on the employment goal. His words, not mine. When we talk about the Fed sort of missing some of its targets, or at least not meeting them in full, is this more a function of them getting it wrong in terms of the theory, or is this more about implementation?
Oh, I actually don't think the Fed did a bad job in practice. In practice, they had easy money when we needed easy money, and they never tightened very much. There was a little bit of tightening that was clearly premature given what we've seen, but it probably didn't do a whole lot of damage. And it's not clear to me that there's much more that the Fed could have done to boost the economy. I'm something of a QE skeptic. I don't think it did any harm, but I don't think it's a tremendously powerful tool. So no, the Fed, they need to think about their analytics, but I don't think they've actually screwed up too badly on actual policy.
One thing people say is they're like, okay, the Fed hasn't done much either way to slow down or accelerate growth. It hasn't been able to generate inflation in terms of consumer prices on a sustained basis. But they say asset prices that we see in real estate and the stock market are a function of low interest rates, low nominal rates. How much of a link is there between these sort of valuations that we see in financial markets and the approach from the Federal Reserve?
Well, there's clearly a link between low interest rates and high prices. I mean, bond prices are high, and so are other asset prices. And it's now the point is, and that's especially true. Anything that where you can't create more of it, like land, so real estate, but also it looks like a lot of corporate profits are actually basically monopoly rents. So those get bid up in price as well. So, but the question is, are the low interest rates somehow wrong? This is only a problem if you think that the low interest rates are inappropriate. And it looks like we actually have a world which is awash in savings with no place to go. So you want to have low interest rates. In fact, our problem is that even low interest rates are barely sufficient to keep us at what turns out to be full employment. I mean, I was just looking at your chart, 1.52% 10-year bond rates. That's incredible by the standards of the past.
So then do you not think that there is a need for some, I guess, quote unquote, normalization to move rates back a little bit higher to give the economy a cushion should it move into a recession?
No, it actually makes things worse. I mean, you don't want to bring the inflation rate down even further, which means that real rates can't go as low as they would when the next recession comes. That's a bad argument. And no, I don't think the Fed, it maybe. If you have something like the housing bubble, then maybe the Fed should be trying to pop it, or even there it's a little bit hard. But for us to say that the Fed should be raising interest rates despite the absence of inflation and the measures that we normally look at, that doesn't make sense.
How does an economist, turning gears for a second, or you in particular, think about the risks from sort of an unexpected exogenous shock like the coronavirus we're seeing, and try to get a handle on the risks that pose it to the economy?
Okay, so. It's an integrated world. Right. I mean, I actually wrote just the other day about the coronavirus, starting with a boneheaded remark by Wilbur Ross, which is something he provides on a regular basis. And we're saying it's good for America. It's not, because we have this world of supply chains. China is a quarter of the world's manufacturing sector. It's integrated with all these supply chains. It can be highly disruptive. We don't know that yet, but it certainly looks like it could be. And then one of the things to worry about is if it is a significant negative shock, and we don't know if this is the one, we don't have a whole lot of cushion. The Fed doesn't have much room to cut interest rates. The ECB, the Bank of Japan, have zero room to cut interest rates. So it could be nasty, but I'm not an epidemiologist.
So is there not a Fed, a central bank?
You're the only one. Everyone else has become an amateur epidemiologist
right.
overnight.
Is there not a central bank policy response then that could be effective in dealing with this?
Well, this is a question. I mean, Ben Bernanke still thinks that quantitative easing can do a lot. I'm a skeptic on that. I mean, they should try for sure if this happens. But the standard, the Fed funds rate really has not much room to fall, and it's still very much an open question whether the other stuff they do has very much traction.